Yeah, I'm losing my edge.
Had a huge move in U.S. Treasuries here, which is really moving these interest rate products that are new to the small exchange, just 4 days old, actually 3.5 days old. I'm rounding up. We launched S2Y, S30Y, 2-year, 30-year yield product, both small products relative to the traditional interest rate markets, Pete. And those traditional interest rate markets are moving around very, very big today. We just saw a huge move lower in note and bond prices, a huge move higher in the yields. And I just, before getting your take on it, Pete, I just want to give our audience a little bit of context, because we have our yield products, Pete, up by anywhere between 50 cents and $1, $1.50, which is $50 or $150 there at the extreme with the 10-year and 30-year product. And that's a pretty big move. That's a big day for these products. They're very young, but that's more than we anticipated the average day, and it's an outlier day in rates. Now, that being said, those traditional futures, ZN, ZBs, and all of those are down multiple thousands of dollars. So a really nice day here to be trading small yield products. And with that, Pete, can you give us a little context as to what is going on before we look? We're looking at Flatteners and Steepeners today, and it is a historic day going back to 2015 to be trading Flatteners and Steepeners. But what just happened a couple minutes ago, Pete?
Actually, so the government auctions debt. When they do it at 12 o'clock noon. And we just had an auction in 7-year notes. So not the 30s, not the 10s, not what we trade. They sell all kinds of durations, 2s, 3s, 5s, 7s, 10s, 20s, 30s, 7-year note. Now, when they auction these notes, there is a consensus basis where the market is, where this auction is. Now, there is a guess as to who's going to participate. Now, the more, and everyone's got to submit a bid for this auction 15 minutes ahead of time. So at 11:45, you kind of got to submit your bid. And a primary dealer, these are financial institutions that have a direct relationship with the Treasury. There's good and bad with that. You're the first guy they come to. You also are compelled to participate in these auctions. So you put in your bid and you feel you've hedged yourself and you're in a pretty good position. And the auction comes out. And if there's not enough participants, or the participants didn't bid as aggressively as thought, there's a number of different prices that get hit. A good auction means all the debt was bid, it sold at one price, and all the guys who wanted to buy it, some of them didn't because the market was bid to a point. This auction had what they call a 4.4 basis point tail. So a huge tail, which meant it took 4.4 basis points of prices to get this entire auction sold. What does that tell us? That guys are not stepping up to buy U.S. government debt right now, and that is incredibly problematic for the government. So it's the first time we've seen a tail like that, which meant like not everybody's lining up to buy this, and they had to go through a lot of bids to be able to get all this debt sold. That is an indication of appetite at these rate levels. So if there's not appetite at these rate levels, what happens? Well, yields move. We just saw that. Long-term treasuries went from 158.26 to 156. So when was the last time we saw a $3,000 move in literally 30 seconds? So that told you there were a lot of guys poorly positioned in this auction, and elasticity is starting to come back to these rates.
Well, Pete, so correct me if I'm wrong. I want to just try to summarize this for the viewer, because auctions, I mean, I literally specialized in trading treasuries and Eurodollars, and I still don't really understand auctions. But let me try to summarize it like this. And Pete, you can come in and smack me down if I'm speaking nonsense here. So they go into auction this 7-year treasury. What they find is not as much demand as anticipated. So to meet that demand, those interest rates have to increase, and thus the prices come down. And so when that auction news comes out, you see, oh, wow, not as much demand. So the interest rates have to be higher to actually drum up some demand so that people actually buy these treasuries at the 7-year auction. When all of that comes through at 12 o'clock, the futures prices of the notes with the ZN futures and the ZB futures and everything along the curve there, they fall huge. And the yields with our small exchange treasury yield products rise huge as a reflection of that reduce demand, less demand than anticipated, and thus rise in interest rates to try to increase that demand, or at least have, I guess in this conversation, it's getting this broad, but the supply of a higher interest rate meet the demand at that rate. Is that more or less what happened?
That's exactly what it is. It was supply and demand working out in its rawest form with something that we're not used to seeing that with.
Sure.
So remember, yields were sitting at their highs. When markets, and we haven't seen this in a long time, when markets move into uncharted territory, pricing what's fair value becomes more uncertain. Liquidity starts to thin out because guys aren't quite sure that the previous mechanics of or dynamics around pricing are going to hold. So that was textbook what we saw just now. I don't want to say, oh, that was an exhaustive gap. Whatever it was, it told me a couple things. One, there is life in this interest rate market, which is great. Two, that there is a little bit of challenge of pricing of where I need to price these. Guys are not getting comfortable. And the dynamics of, we've talked about for 3 years, guys, 2 years, guys have said this budget deficit is unsustainable. Well, we've seen the government the Fed be able to buy bonds. And I think I said this wrong last week. The Fed does buy bonds and holds them in their inventory.
Okay.
Can them buying bonds overcome the amount of debt the Treasury has to sell to fund the spending? Well, that's being challenged.
Yeah.
We always love best markets in the world are when the market challenges an institution. We saw it, and I mentioned with the Bank of Japan, we saw it with the Bank of England. Now it's the Treasury market challenging. All right, you 12 chuckleheads, 3 of the chuckleheads have spoken in the last 3 days saying rates aren't moving to 2024. Well, we'll see. Now there's a question, and it's so interesting. Tom Sazov asked me this today. We did a segment earlier, and it's like, when does this part of the market force the Fed to move? And we've never talked about that in so long. In other words, the thinking is, well, whatever the Fed wants is what happens. Here's the question of, is the marketplace bigger than the verbiage the Fed can use to control it? That's the dynamic playing through right now. Couldn't ask for a better. I know it feels unnerving, like, wow, the rules are out of place. Absolutely. As traders, we want the rules not to be out of place, but to be uncertain. That's where we get opportunity like this.
No, very well put there, Pete. And yeah, if you please, this is one of the few times, not few times, you and I are pretty smart guys, but we were ahead of this with talking about trading against the Fed earlier this week. And please go into our archive and look at, I think it was either Monday or Tuesday, someday earlier this week, we talked about what we're seeing play out right here. Like Pete just spoke of, the Fed saying these short-term rates are going to stay at zero. We're going to keep buying these bonds and keep other rates at zero across the yield curve. The market today challenging that, and thankfully these small yield curve products just launched this week, allowing you to trade with or against the Fed, however you see fit, with small, simple futures. And so please go check that out in our archives. But we do have to get into yield curve flatteners and steepeners, which, Pete, today are as interesting as they've ever been. We've got this 10-year future. It's the first small interest rate product that we launched, and it's presented a great amount of interest rate speculation. Just like today, a huge move higher in rates above 1.5% in the 10-year for the first time since I don't even know how long, Pete. But what's also interesting is pitting these different durations against each other. And on a day like today, where everything is moving, we're getting some of the biggest moves in interest rates all 2021, probably the biggest moves since pandemic news broke out in the early part of 2020 here today. And everybody goes to that 10-year first, Pete. But today I want to advocate for some of these spreads between 2s, 10s,
Absolutely.
10s, 30s, 2s, 30s, what have you, because the performance is extremely varied, right? Look at this chart.
Absolutely. And this is, you know what, we've seen this, well, you know what, in 6 months, everybody's going, oh, those were artificial rates when we were at 11 basis points in a 2-year. It wasn't artificial rates. That's where the market was. There's nothing artificial about it. you know what? It was a traded price, and I hate post fact. Everybody says, "Well, they should have never been down there." Hey, you know what? They should be where they should be. But on a percentage basis, absolutely, this dynamic nature of this 2-year, and you hit on this not rarely, but do we get 3 underlines that are the exact same thing? And what I mean by that, they're U.S. Treasury, risk-free government debt, with a single variable, not multi-variable pairs where there's lots of different things driving them. The only thing is duration, how long the instrument is. Look at the opportunity, and this is a great visual to speak to that. We were down on the year in 2s, while 10s and 30s were actually dramatically on a percentage basis up. Today, I think that 2 has moved to up on the year. I have to go back and look yet. I'm not sure, Frankie. Are we there?
Yeah, I think we've eclipsed the 0% year to date in the 2-year. Yeah, sorry, I should have put a legend here, but you've got in red the 2-year, and you can see on the y-axis that it's been a dance between $1 and $1.50 all year, which is 0.1% and 0.15. Whereas you look at that white and that gray line, and you look at that's the 10-year and the 30-year respectively. And you look at the y-axis that's in white and the y-axis that's in gray, and that's a dance between, for the 10-year, Pete, $9 and today, right now, $15, which is 0.9% and 1.5% compared to those 2-year rates sitting around 0.15%. And so you see this huge climb in the 10-year and the 30-year. The 30-year well above 2% now. The 10-year, reaching heights of 1.5% they haven't seen in months, at least, going back to pre-pandemic days, Pete. And yes, these products offer great opportunity to just, I think rates are too high, so I'm going to sell 10 years, or I'm going to sell 30 years, or I'm going to sell 2 years. Oh, I think that this is just the start. They're going to, continue to have these legs to the upside. I'm going to get long 2 years or long 10 years or long 30 years. Great individual trades. Right. But I do want to speak to the fact that the TUT spread, the difference between the 2s and the 10s, Pete, has seen some historic levels of steepening, actually out to right now, the most steep that we've seen this spread, the difference between 10s and 2s, the most steep that this spread has been, Pete, since 2015.
Yeah, it's fascinating, isn't it? That, we're now starting to get to levels we haven't seen in 6 years in terms of dichotomy. And, you think there's a sense sometimes when I miss the move in yields. There is nothing to have missed. The frustration was trading yields for the last 6 months or year. Yeah. Now is the opportunity to start to, you haven't missed anything. And it's not like you've got to jump on to being long yields here. You could see here the dichotomy between just 2 of those different durations is so extreme that all of a sudden you've got plays, outright plays, assumption plays in terms of bias, and then extremes within the different pairs. Lots of trade setups here to take advantage of. And I think you hit on the easiest thing here. You and I, we've learned teaching interest rates in the institutional world that we brought individual traders into. We always felt a little bit exhausted going through the DV01, the weighting. Look at the CME Treasury Analytics site. Here's all the things that continue to move that make it challenging for you to even come up with a ratio that holds. Yeah. And I think the greatest thing is we always, you and I especially, we go down the rabbit hole products, and sometimes because we're in a zeal to build the coolest thing possible, we can have a proclivity to sometimes build something that might be a little overly complex. Then we always go back to our axiom. If you can't explain it in 3 sentences, you've built too complex a product. Here you are. You could trade yields, Flatteners, Steepeners, the ratio is 1-to-1. That's all you need to know.
Yeah, absolutely. It's funny here in 2021 where I think the proclivity of a new exchange, like if Joe Schmo on the street started his futures exchange last week, he would say, oh, well, I need to bundle up all these cryptocurrencies and get the most intricate crypto product out there. And we are working to get a crypto product out there. But this week, Pete, I don't think there's anything more interesting than a simple interest rate here, because that's the asset class that today, who would have called it last week? Nobody. But what's really, really moving, of course, stocks and everything else moving here, and we'll get to that in the next segment. But yeah, having this 1-for-1 trade for flatteners and steepeners is extremely relevant here in 2021. And yeah, it all starts with flatteners, steepeners, spreads across the yield curve. It starts with one side of one of these parts of the curve that you like. And I jumped on with Liz and Jenny on the show earlier today and talked about, my good friends Liz and Jenny.
Yeah,
but I talked about the fact that if you're starting out and you don't want to go into the flatteners or steepeners or spreads, I don't mind just a long 2-year play here. Or if you think that rates are going to fall, they're going back towards zero, a short 2-year play. It's a product that's under $200. The margin right now under $100, and you can really, even with these outlier moves, Pete, very manageable for most accounts. So maybe you start with just trading that 2-year one way or the other. But if you do want to look at this historic extreme in terms of steepening here, and this is the touch spread, this is the difference between 2s and 10s, right, all the way up to above 1.3% here, which is correlating to $13 on that y-axis, then you could look at the long 2-year and the short 10-year as a flattener trade. Then you want this historic steepening to come in. You want these rates to get closer to each other. And that can happen one of two ways, right? The short-term 2-year there can start to climb, like a lot of people think it should climb, but it's being held lower by the Fed and their influence on short-term rates. Or you could get paid from that 10-year coming back down and seeing a little bit of downside. That's the nice thing about these flatteners and steepeners. The steepeners the same way. It can pay you no matter what. If interest rates are moving higher or lower, it's a relationship trade.
Absolutely. And that's the next iteration of adding opportunity in a new set of extreme trader toolbox. The question always is, what's the lift? What's the complexity? The different tick sizes, all that stuff. This is a very elegant, simple world to do that. And, I want to speak. So we've had this huge move today in yields. I did two things. I sold some 10s, which I'm out money on right now, about $40 a contract. But I did a 2s, 10s flattener. And that is actually, I'm out $3 on. So does it always, by trading the curve, slow the amount of movement down? Not necessarily so, but we know for the most part, it creates a slower trade and a diversified trading opportunity. So these are what we really like about adding these other, what we call knots on the curve or durations on the curve are powerful tools. You made a living for them many years. I did too, trading them, but they were, they were complex and they were limited to understanding by, just a very few. And I would think a lot of days out of that, we would probably say, hey, I didn't understand them as well as I thought, because it wasn't clear what put that P&L on your statement. And that is a very interesting dynamic. So within this, and the other thing I want to talk about, you asked me a little bit at the start about a little bit of the story of what just happened. Traditional financial media, and we don't even talk about, hey, there's an auction coming out. We know it just because it's happened. We've got to monitor our cash treasury indexes. So we just happen to know, as running an index entity, when the auctions are and the underlyings are substituted. Trust me, if you watch CNBC, they've never mentioned that, there was just a 1202, there was a reissue that just went on. Today, everybody's going to be talking about
everybody's going to talk
about
it.
And the next one coming out, this was the last one for the week. There'll be another set next week. Trust me, Tuesday at 11:30, every chucklehead on that will be talking about what is this, and it'll be some 3-year TIPS, which is a Treasury inflation protected security. Don't worry about what TIPS means, but it's just another chunk of debt the government has to sell. This will be the topic du jour. And don't get caught up in what the auction is. Just be mindful that this is now starting to shape elasticity in the market. I don't want to know what the auction is. The market will tell you what the auction is way before you hear about it on the news. Just take it that's going to be the new tradable opportunity here. And I love the fact, Frankie, touch spread is, we've had a lot of guys who we've taught this in the institutional world to self-directed traders, and we get this small subset of guys who can spend the time and the bandwidth to put all these components together. And it's not a knock on anybody. We look at, I look at trades. There's a overnight repo market that you can trade futures on. It's so freaking complex. You're gonna break everybody's brain with the repo market. I don't even want to talk about, because I can't figure it out. And it's not like, if I can't figure it out, it's not tradable. It's not for people with regular jobs. It's not
baby steps.
This is simple. This is easy. And you know what? I like the fact that while you look at these huge moves, I'm not at one point out $3,000 on a single one lot. Sorry, that's the end of my diatribe.
Until now, this trade, Pete, has been nearly impossible for the retail, everyday, self-directed trader to be a part of, because it's been DVO1 this. These traditional futures ratioed 3-to-1, 5-to-2, and all of those products, a one lot being hundreds of thousands of dollars in size, and then asking the retail participant to do a bunch of math and also ratio them out. So I've got 3 products at $100,000 a clip against 2 of them at $200,000. It's craziness. Right here, you have the opportunity to trade the yield curve in the outrights, to trade the flatteners, the steepeners, everything that is moving in the market and that you will see news stories on for the next several hours and days here, with one lots that are margined at $50, $180, or at most $300, and product sizes, Pete, that are $200, $1,000, or $2,000. Flatteners and steepeners that are 1-for-1. You go from tut spread to knob spread, Pete, 1-for-1. You want to trade the tub? You want to be a cowboy and trade 2 years to 30 years? 1-to-1, man. It's never been this simple and this small to trade yields, and it's a great week to do so.
I was wondering when you were going to pull out the dreaded tub.